you're going to be like, okay, let's just tweak these things here a little bit. And then it's like,
bang on. I researched it. I came to country at the age of 17, migrated from.
oh, wait, all of a sudden I can afford to buy it.
She said, go for it. Why not? That affects the total debt service, and I work for BioVectra.
Yeah.
And basically using max utilization of your credit cards and line of credits can get you. I like helping people. I have a caring nature and I want to see the best interest of my client. He should be he should be proving enough that, okay, that retail space is gonna come out. Coming up like the documents where it's like, you need a solid business plan. Myself, we make notes and we send it to this lender and their underwriting team gonna go through it and be like, if you have credit cards and line of credits, and I'm not saying don't give importance to it. It is important, right? Because, after pandemic, we are more towards like a video calling or like doing Zoom meetings or something. But, I think when you meet in person, you can feel the vibe of the person, right?
Welcome to the Real PEI Podcast, formerly known as Chattel Fixtures. What do you think of the new name? Today, we're diving in the world of mortgages. Jay Patel is a highly regarded residential and commercial mortgage broker based in Charlottetown, Prince Edward Island. Known for his innovative approach and trusted advice, Jay helps clients secure financing tailored to their specific needs. Jay, welcome to the show.
Thanks, David. Thanks for inviting me for today's show, man.
Yeah, absolutely. My pleasure. I think it would be kind of good to start with the fundamentals. Oftentimes when people are kind of, especially when people are first-time home buyers, so many questions. And also, even as a realtor, we're not dealing with this in and out. So it's nice for me to make sure that, I don't give advice regarding mortgages, but I like to kind of have a rough understanding to be able to then when I point them to someone, make sure that it makes sense, if that makes sense.
Right. So I see it as main 4 to 5 components. The first important, I would say, for a first-time home buyers is this credit score. Generally when people are first-time home buyers, they are in the market thinking of buying with as low as 5% down payment.
Yeah.
But which is an insured mortgages.
Yes.
So there are some set of rules that an insurer, which is above the lender, they check it, and there is minimum set of requirements. So any credit score should be more than 600 for both the applicants or single applicant who is going on title for such kind of mortgages, who is looking to do minimum 5% down payment and getting a home.
Okay, so to unpack a little bit of that, so the first one you're talking about is credit score.
Yes.
Right, and so I think, to me, and I could be wrong about this, the 4 main ones that I think of are debt service ratio, net worth, and credit score.
Yeah.
And the appraisal maybe is in there or maybe not.
Appraisal is
more for the property itself.
Yes, more for the property, because the lender would, if they are lending, they want to see, right, if there's a value on the house that they are giving the lending the money on.
Yeah, exactly.
So that's
more just them confirming with the property, not so much something that the buyer has to be.
Yes,
yeah.
right.
So you mentioned credit score in terms of getting a 5% loan. No. So the part of that to unpack is, you mentioned insurance on loans, especially for first-time home buyers.
Yes.
If you want to do less than 20% down, you have to get insurance, which is usually through CMHC, or there's other people that do it too, right?
There's other two, including CMHC's Canada Guarantee and Sagen.
Okay. And if you want to do less than 20%, that basically insures the mortgage so that if, things fall apart, the lender is protected, at least to some extent, right?
Yes. And that's why the credit score is important. And that's why the credit score that insurers are taking is minimum over 600.
Yeah.
And that's a lender requirement too, if you want to do it with anything less than 20% down payment.
Okay. And so people do you advise people just check that before, like going Credit Karma or something like that? Or do you do a search for them on the credit score when they first meet you?
Yeah, generally when they come for pre-approval, we do our due diligence, especially me. I do my due diligence that the credit score is well enough before I tell them, okay, you are qualified for 5% down payment or not.
Yeah. So 600, is that kind of the main baseline people should be shooting for?
Yes.
And then above that, does it help? Say if you're 700, 800, 850?
It helps in certain program requirements. Like, if you're buying something with an in-law suite, like a rental income on the property, you need to have minimum 680.
Okay.
For for making the deals work out, like having extended to write off your heat and property taxes, some lender will say, okay, give us 680 for the credit score.
Oh, okay, yeah.
Yeah.
But then the different lenders might have different criteria
yes.
for that.
Yeah.
Okay, that's nice to know. And then like just with that, since we're on credit score anyway, I'll just throw out there, the most important thing is to always make your payments, right? Like that is number one thing. Always make your payments on time, even if it's the minimum payment.
Yes. And
then debt to what is it? The amount, debt utilization, right? That's pretty important, right?
Yeah, because if you have credit cards and line of credits, you don't want to do maximum utilization before you go for buying a home, because that's going to affect, when you mentioned one of your fundamental was GDS, TDS, right? That affects the total debt service, which is TDS.
Yeah, well, for sure.
So that like affects your qualification. Yeah. And basically using max utilization of your credit cards and line of credits can get you less qualified amount compared to if you had minimum utilization or zero utilization. Yeah.
So in terms of the credit score, say if you had a $30,000 line of credit and that you had $25,000 borrowed on that line of credit, that would be a high debt utilization. Or say if you had $1,000 a loan on that, that'd be a low utilization. But then that, in addition to affecting your credit score, that affects your ability to borrow through the debt service ratio.
Yes, 100%.
Which will maybe, to me, that's always the one that I think of as kind of the fundamental in terms of what someone can afford.
Right.
So debt service ratio is basically the part of your income that this mortgage would represent, or that these loans would represent. So if you made $100,000 a year, 40% debt service ratio would be $40,000. Is that about right?
So your GDS works is the maximum shelter cost as per your pre-taxable income.
Right.
Okay.
So pre-tax income.
That will just do your GDS.
Yeah.
And then your TDS will come where we add back all your credit cards, what you have owing, your line of credits, your car payments.
Yeah.
And that is what's going to, determine what max you can go about it. Mm-hmm. So the ratios for insured, right? They are like, you only need 39% allowable for your gross debt service.
For GDS, which is just for the house and house cost.
House cost, like a shelter cost.
Heating and
the mortgage only.
Mortgage only. What about property tax?
That goes on the TDS.
That goes on the TDS.
TDS, yes.
Okay, cool. But the heating cost wouldn't factor for either, right?
No, it does factor on your TDS, right? Because that's a cost, right?
Okay, yeah.
Yeah.
So mortgage is for GDS and TDS. What is, say, for CMHC, their percentage requirements for GDS and TDS?
GDS, it should be 39%.
Okay.
And TDS max is 44%.
Right.
Because that's where on TDS, that you see the difference, that is like 5% between GDS and TDS. That 5% is for including your heat, property taxes, your car payments, your credit card, your line of credit payments, whatever it is.
Yeah.
You have to buffer in that 5%.
Yeah. So that's not a lot to work with depending on the scale of the purchase. If you, again, this is one of those things, probably when preparing for this, if you can ideally not have a car loan, have your line of credit paid off, have your credit cards paid off.
Yes.
I know that's a high bar when people are in pressure. It's not just automatically going to happen like that.
Right.
But if you can do that, that is going to make a huge difference. Right?
100%.
And because it's, oh yes, we could afford this house based on our income, but not when you factor in our other debt.
Right.
And so that other debt is a critical part of that application. And it's a deal breaker, right?
Yes.
Every lender for a residential.
Yeah. They're going to look into it. All the good lenders you want, they're going to look into it.
Yeah. So that is huge. If you can get that, then it comes down way more to just, can I afford this particular
payment? Yeah.
And this particular payment. Yeah.
Like I have seen clients who are making $100,000 a year, but they had high utilization on their debts. They could only afford $250.
Right.
But and then clients who had making $100,000 with zero debt came to me and they got into around like more than $420,000 home.
Right.
So you see the difference of more than $150,000 affordability, right?
Yeah.
And basically and they both were putting 5% down.
Right.
Right? The credit scores of both the clients were great. but the deal was like they got it lower because there was high utilization. They're having huge car payments, right?
Yeah. So, I mean, practically speaking, if you're choosing house first or car first, just get the house first.
Yes.
Right?
And I say this all the time to my clients.
Yeah.
If you have a house, anybody's going to give you a car. If you have a car, you are limiting, not everybody's going to give you home.
Yeah.
This is what I tell my clients all the time. And, I have appreciated clients whenever they come. I'm not saying you should not drive a fancy car. You should. Everybody has desires, right?
Yeah.
But if you get your home, I say you're going to get the car. Nobody's going to turn you down.
Right. Yeah. But the other way around,
Yes.
not so much.
Yeah. Because,
especially if it's, if you have a smaller loan payment and you have a high income, it may not affect
right.
the particular house you want, but it does affect, it does at the top end of your budget.
Yes.
Even a small loan does have some marginal effect.
yes, it does.
Yeah.
It does.
Yeah. And then also those other costs are pretty important too. Like I have, that's really interesting to think about. So I've got, sometimes when you're dealing with an older home that has maybe a bigger heat bill, also in some cases, other utilities that are higher,
Right.
Versus something that is really well built and new.
Right.
Probably for new construction. Do you just base it on, is there like benchmarks that they base that on?
So basically, whenever we do the mortgages, right, for the heating cost, we don't, put like a more heating cost for like an older home versus less heating cost for a newer one. Like lenders just have a specific benchmark that, it doesn't matter, it's old or new.
Oh, okay.
We are putting a one same dollar value. Now that
is that a percentage of the value
no,
of the home,
it's just
a flat.
no, it's just a flat.
amount?
It's just a flat amount
Okay,
that
so
we added
it's
on
just
the
in
application.
there, kind of like
just to
general,
put it in general in your calculation.
just to make sure there's a little bit accounted for.
Yes.
that, but it's not meant to be precise.
No.
Okay.
And then general is depend like $125, $150 we add it on the application a month generally that they count on the TDS side.
Which I guess over the course of a year, so say if that was $150 times 12, you're looking at $1,500, $1,800. And so, which would mean if that was 39%, we'll say 40, that would mean that you'd have to make a difference. You'd have to be making like $4,000 more or something like that, or $3,500 more
does. Yeah,
a
it
year.
does. Yeah, because it's on your
on that.
application. Yes.
Yeah, which is interesting. That's a part of it.
Yeah.
So that'd be something to factor in, and that'd be part of your TDS though. So ideally, your other loans are really low, so it would have virtually no effect.
No effect, right?
Yeah.
And like generally, for some lenders is a different value too. Mm-hmm. So 125, 150 is not for all lenders across Canada. Some of them will be like, okay, we want to do 225, 250, but it's just some specific lenders. And it's just that like, if you have to use that specific lender, you have to put that heating cost in accountability in your TDS.
Yeah. Okay.
Yeah.
Okay. Yeah. Got it. Okay. Yeah. There's, I guess when you're looking at this too, it's like, you want to be able to afford whatever place you're getting into.
Right.
So if you do have all these loans built up and all these payments, and then you're getting into a house on top of it, you can see why it's like, this could be really stressful.
Right.
Like you might be better off just, depending on what happens in the market, waiting till you get those things paid off, and you might have to. So it kind of self-regulates a bit. I mean,
sometimes I told clients, I'm like, okay, guys, you go pay off your little debts this off, take a couple of months, come back.
Yeah.
And you can actually get in the home which you actually really liked in a couple of months, right?
Yeah.
And it's me, like I always, if the clients are, coming to me and I always prepare them and make a plan for that. This situation can change in 6 months. If you make your payments on time, and if your credit score is low, you can build up your credit score, make your payments on time, your debt's been paid off. So basically that $250,000 client would in 6 months would be ready to go in $400,000 home, which he actually wanted, right?
Mm-hmm. Awesome. So if someone is like, okay, I might or might not be eligible. I feel like I'm close. I'm ready to buy a house. Okay, Jay, can we sit down and you go through it with me together? Let's make a strategy.
Yeah, 100%.
Yeah, so you're probably doing that all the time.
Yeah.
Awesome. Love that. So another one is net worth. Like I know that's partly the fact. I feel like that factors in when they're at some point in this, right?
It net worth it does matter, but
It's not based on that primarily. They just want to make sure you're not underwater, right?
Right. Yes, because apart from just your down payment, 5% also, they want to see you have enough cost to do your closing, right?
Yeah.
Because if you are able to pay your lawyers, your land transfer tax if applicable or not. So they want to see that money's there. And
they want to see a net positive net worth, I think, too, right? I feel like they've asked for things like that from me before just to show it. Even a paid down car, I feel like they asked me what it was worth. Or I feel like there was some net worth form I've done
there is
before.
a net worth
this
that
is how
you
much
added.
Equities I have, this kind of things.
Yeah.
Is that factor in very much as long as you're not, if you don't have debt, it doesn't really matter?
It doesn't really. If you have zero debts and you have enough to cover your down payment, closing cost, and just little money also, it's okay. They were not going to turn you down for it because they know that
that's kind of the boundary of
it. Right. But having some net worth that adds the value, right? Because it's going to make the lender confident that these guys have their financial situation pretty much figured out and they're in good standing.
Yeah.
Right?
Okay. So less likely to default, less likely to get in trouble.
And
mispayments, that kind of thing.
Mispayment, no foreclosure or anything, right?
Exactly.
So
which nobody wants. Cool. Awesome. And what about, go ahead.
And about loan to value, right? When you're doing purchases, as we talked about insured mortgages, right? You are doing less than 20% down. You can go up to 95% loan to value.
So loan to value is the ratio of the loan versus what the place is worth.
Yeah. So basically, if the home is $400,000, you put 5% down, they can lend you 95% of the money.
So you're paying $20,000 down on the $400,000.
Yeah. And then they add your CMHC insured fees on it. And there you go. And then it's different, right? For refinances, when you want money out, taking out equity, right? The max, they go 80%. Now there is new regulations where you can do the refinances up to 90% if you want to build a secondary suite in your home and add a rental value to it. But generally refinance is it depends. Refinance is max 80%. It can go lower also 65%, 75%, depending on location, the comfort of the lenders, how much they want to lend you. At that time, they will also see what you can really go according your total debt services, how much you can afford, right?
So there might be some subjective elements to it in a way with a refinance. So for the first time home buyers or the new people, a refinance is after you already have the house. If you say, okay, I want to increase my mortgage, what they could do is say if the market changed and the value of the place went up, or if you did improvements to the property, they could go in, they would hire an appraiser to go in and say, okay, the house instead of 400 is now worth 450. And so we could now loan you 80% of that, which is whatever. And that's a way of, say if you need to pull equity out of the property. Now, obviously that's still a loan that you have to pay back.
Yes.
So if you're doing that, make sure you do it wisely. Some people would advise never doing it. And some people will do that to start a business, and it can be a risky thing because you're putting your house on that. Or sometimes the old school, old school to me. I used to be big into listening to Bigger Pockets and those kinds of podcasts and stuff like that. And they'd be doing BRRRR. So it's the BRRRR, I was what was it? Buy, renovate, refinance, repeat, right? So it's BRRRR. And so you'd buy it, you'd fix it up, right? So if you had a place that needed some work, you get it reappraised, and then you'd be able to take the cost of your renovations back out of it. Oh, I guess rent is the other thing. Cost your renovations back out of it, so that you could say if you were paying it with your line of credit, you could take that money, pay off your line of credit from the mortgage, which typically has a lower interest rate and lower payments because of the longer amortization.
Right.
And then say if you rent it, then
to make money,
you can pay down the mortgage and build equity in the property. So
people do it, and sometimes people come in and they want to refinance because that there is equity that they can come out, do investments, safe investments, which give them 15-20% return, right?
Right.
And if they're refinancing at maybe 5%, right? But they're paying 5%, but their investments, whatever they take out, is making 20% out somewhere.
Right.
Then maybe they will put it in another property as down payment and buy a rental, right? So it just really depends on refinances, why you want to do it. And sometimes you want to do it to, do renovations add a secondary suite, maybe have a rental income from it. And, the cost of borrowing maybe is like if you're paying, for example, $1,800 by refinancing, you can increase your amortization back to up to 30 years. So your payment is still the same, what you are paying, but you have money that you worked for renovations and made like added value to the property, and now you have a rental income suite.
Yeah.
So that is like really, like what you want to do and like do investments. And I have clients all the time coming, want to buy a bunch of like, take out the refinance, take out the equity, put in another rental property, or want to do just safe investments. Why not?
Yeah, absolutely. And that is one of the things about home ownership that is very advantageous, or real estate in general, is that yes, in a way, the equity, meaning the difference between the loan amount and the value of the property that you have. So if you had a $200,000 mortgage on a $300,000 house, you would have $100,000 in equity. That equity, while it's in the house, sitting there, and it's hard to get at without selling, you can actually pull some of that out in the form of a mortgage to be able to use that for other investments. And that is something that people have used to grow at a really crazy rate their wealth in certain cases, because often what people don't factor into these equations, and this is not advice for every person. This is someone who's like just a tactic that people do just to be aware of. And one of life's options is, say, if you pay 5% down and it's the $300,000 house, maybe in the country or something like that, or maybe it needs work, and you have 5% down. So you only pay $15,000 plus, your closing costs, CMHC fees. And if you're not a first time home buyer, maybe your tax,
land transfer
tax.
Yeah.
But that 15, we'll say $20,000, if that place goes up in value by 10%, well, already in equity, you have you now have a place that's worth $30,000 more than what you bought it for. So in equity, in terms of your wealth, you now had a 50% return. If that property goes up 20% in value, that is like a huge, because that's, say if you had 5% down and you get 20% growth on it, that's 4 times.
Right.
That's like a 4x on your investment. So you can imagine how scaling with that is attractive to people if you can manage it properly, because you're taking on a lot of responsibility with these things. These are not just like, these are actual houses that need maintenance and need care. And if the roof goes, the place can be ruined. Like, this is not just a like a toy that you can just this is real life stuff, right?
Yes. And for such kind of refinance, you need to own more than 20% equity in it
in order to get anything out of it.
In order to get anything out of it.
Yeah.
So if you have 25% equity in it, you still keep 20, and bank will give you the extra 5% equity.
Yeah. So if you need to get 15 grand out of that $300,000 property,
you can get,
or say if it's and then, I mean, you can imagine cases where, like, think about a place that pre-COVID was worth $250 and post-COVID was worth $500. And if they, and if they paid 5% down on that, they paid $12,500 and got $250,000 back in equity. It's kind of insane. That's literally a 20x return on 100%. Capital. If you did that a few times over and over again, you could become like, have more money than there is on planet Earth. It's like, it's a crazy rate of, it's like an order of like, not 2 orders of magnitude, but it's like an order of magnitude plus 100%. Like, it's
because your money is building, right? Your money is growing. Your equity is building. And we can see the PI real estate, right? Because during COVID, what was worth, and now the rate of the real estate, what is in PI, we can see that people have got advantage of it. And
for the people who are owners, and if you're not an owner, that is such a pain. Like, it's like, it's one of these things. It's so unfair, but it is good for you as an individual to know what the reality of the situation is and the reality of the world, so that you can have that access to information. And if you don't want to participate in it, at least you know how it works. And if you do want to participate in it, you got to approach with caution too, right? Like, that's what sometimes people forget. It's all fun and games until it doesn't go the way you hope it goes. And so, man, we could go deep down that rabbit hole.
Right.
And I want to kind of pull it back to a couple things. I might, I have this like, maybe we'll just touch on the self-employed versus if you have a job. My understanding, if you're self-employed, and tell me if I'm wrong on this, is that they take the previous 2 years, and if your most recent year is lower, they'll take the lower amount, and if your most recent year is higher, they'll take 50%, like halfway between the 2 years ago and the most.
They will
current
take
year.
the average.
Is that still what it is?
Yes, it is.
Okay, yeah. So you need 2 solid years of profit, of like kind of on your tax return saying that you had those positive earnings.
Yeah, 100%. And like some lenders, they have policies of like, basically if a person is a carpenter and he was a carpenter for 10, 15 years for one of the company, and he comes out and he does his own and went on his own and started incorporating and is doing carpentry. Some lenders give us exceptions and you can use some of the projected income in that way.
Oh, okay.
Yeah. But it has to be a history,
you need to be smart about it. Yeah. And that's one of those ones like go in, talk to you, like talk through that. Yeah. Yeah.
And and there are special programs for doctors.
Okay. Yeah. So if they're still out of university, have all this crazy doctor debt, they still might be able to buy a house?
Yes, 100%, because there are lenders who have specially professional programs for doctors.
Right.
Where we can use the projected income and make them qualify for a home, even though, if they are in 4th year or 5th year residence and their T4 is just $75,000.
Right.
But that person is a cardiologist and he goes to, for example, province of PEI, and province of PEI says, okay, you'll be making $450,000.
Right.
So, like lenders see that there is income there.
Okay. So there's a special program. And I mean, it's pretty regulated, right? So the government must say, approve these programs, right?
And and lenders know, right, that the cardiologist who is in 5th year residence, for example, is not going to make just $75,000. These people are in the benchmark of making minimum $300,000 or $400,000, right? So lenders know that there is value in these professionals and they would certainly want to lend them the money.
Also, if you're a cardiologist right out of residency, we probably want you here. Right?
Yes, 100%. PI needs
we don't,
workers, right?
Doctors, we want to attract them here. So that makes a lot of sense.
Yeah.
And it also just makes sense from a practical perspective.
Yeah.
And they've already proven themselves through years of university and going through, part of the residency. Yeah. So trust is a big factor in choosing a mortgage broker. Many borrowers may not realize that staying with their current lender and porting their mortgage, for example, could be their best interest. That's just one example of the kind of specifics that require trust in who you're working with. How can someone vet a mortgage broker to ensure they're working with someone who is truly has their best interest at heart? And what should they look for in a trustworthy mortgage advisor?
See, David, I'm a little old school in this one. Whenever I have my clients, and not everybody is comfortable to meet in person, but I like to meet the person in, just right, like in person. Because, after pandemic, we are more towards like a video calling or like doing Zoom meetings or something. But, I think when you meet in person, you can feel the vibe of the person, right? And then you want to see as a mortgage broker, is the mortgage broker has been honest, transparent, and is the communication there, right? Because we as mortgage broker, we work like after hours. So they can expect a communication, right? Yeah. The honest is if they have been working with their bank, are we bringing them more options to the table, right? That's why we are, as a mortgage broker, we have access to this many lenders because we want to bring them best possible option at the table, which is at that moment. Yeah. Right. And I don't work for specifically one lender. So, I would not favor just for one lender. Yeah. And the other thing they want to make sure that am I working for them or am I working for lender? Because to the lenders, I have to represent my client and I want to see the best interest of my client. Yeah. Right. I have seen instances where I even turned down a client because, when they came up with me for talking about a mortgage, and I was thinking, I don't think that was the right time to do their refinance. I've told them, guys, I won't be able to do it, and I don't want to do it because, that is not in your best interest.
Yeah.
So the honesty and transparency should always be there in the communication.
Yeah. Yeah. It's kind of a bit of a vulnerable thing. And it's something that I know there was one mortgage broker I sent someone to, and they sent them back to their bank because they said, oh, they'll be able to port their mortgage. And I was like, okay, this is great. Those sorts of little things can build trust.
Yes.
I mean, kind of on that same route in a way, this next question, beyond interest rates. So most people focus on interest rates when shopping for the mortgage, and obviously we can see why.
Yeah.
But there are important terms that can significantly impact the cost of borrowing. So what key loan terms should borrowers pay attention to? For example, the penalties for early repayments, are they there? Are there any hidden fees that they should be aware of? What kind of things should people be looking out for other than interest rate?
See, always in a mortgage interest rate, people look that number. And I'm not saying don't give importance to it. It is important, right? Because you don't want to increase your payment way too much. But the other thing is the prepayment, right? Generally, good lenders allow you 15% of the principal amount to pay every year.
Yeah. So say if you wanted to pay down your mortgage, would that go straight to the principal?
That goes on top of your regular payments. If you do up to 15%, go straight to the principal.
Yeah. So say if your regular mortgage payment was $1,500 a month, and then it comes December, you had a Christmas bonus from work, or you saved up some money, and you say, you know what, I would feel more comfortable if my mortgage was smaller. I want to put 15% of the mortgage down and pay that, and then boom, that comes right off the principal.
Yeah, it goes on your principal.
And there's no extra
no, up to 15%. There is no extra cost
in that particular case.
Yeah. So you want to do that, and then the another thing is the accessibility to the lender, right? Like, because I know there are sometimes the lender would offer you a lower rate, which can save you $10-15, but then when you need to contact them for your mortgage statements and for any other thing, right? We are always there to help them, but are you able to have their online portal access?
Right.
Because
you can see where you are,
how much you're paying, right? And everything, right? So, because generally when we work with 70 lenders, not every lender has a corner shop in PEI, right? So I try to put them in a lenders which are safe. You are like accessing them 24. You can have access your online portal. Everything is working. And like smoothness. Yeah. Because you don't want to hiccup every month and you have to go to the lender or to the broker. Yeah. Right. So that's the other thing too. Like, that is important to put little emphasis on. Right. And sometimes, if the lender is taking like 0.1, 0.2 more, but then there is various products that they are giving it to you. Right. Because sometimes a lender is taking a little bit more interest rate, but they are throwing a $15,000 flex line of credit along with your mortgage, right?
Right.
So if you are paying $20, $30 more a month, but guess what? Now you have $15,000 as a line of credit, which you can use at any time to do renovations or any emergency fund.
Yeah, the furnace goes, you need a new roof.
Yeah, and then you take it, you pay that off, you again have that access. Right. So doing that, you don't have to refinance your home, right? You don't have to go for another mortgage, because he has thrown you $15,000 right there.
Yeah,
right.
So this is again one of those things where it's like talking to their mortgage broker and saying, "This is my situation. This is what I hope to accomplish." Yeah, you can tailor and customize that as opposed to saying, "Okay, no, this one's the best interest rate.
Yeah, because this is the lowest, take it."
Yeah, but if you cancel your loan early, by the way, it's going to be X amount
of penalty.
Yeah.
Right.
Yeah. What about when people reach their end of the term? Say if it's a 5-year term on the mortgage. So again, for the new people, typically there's like your mortgage is like a 25 or 30-year mortgage is probably, or in some cases 30-year, but 25 is probably the most common. And they have. But that is kind of how long you're projected to pay it. But the term of your agreement in terms of the interest rate, in terms of all those details that are agreed upon is a certain amount of time, like 5 years, 3 years, 2
whatever
years.
you lock in.
And then at the end of that term, is it always automatic that, like, if the market shifts, can they get into issues there, or is it always automatic that it pretty much goes forward?
So as at the end of 5 years, whatever the rates or the economy is going around, right, they would send you a renewal with some of the interest rate options that what they can offer.
Yeah.
And before 4 months of renewing, 4 to 6 months, you can even shop around again, right? Because you have amortized it over 25 or 30 years for the mortgage. But if your term is you have locked in for 3 or 5, you can always shop around. It doesn't mean that you have to stay with the same lender for 25, 30.
So say if you know that your mortgage is up in 6 months, wouldn't be a bad time to give a call.
To give a call and see what's the best option, right?
Yeah.
And
it might be just to keep it rolling.
Yeah, keep it.
And then is that the safest thing? So say if it's someone who maybe their earnings are less than it was before they got that mortgage and don't know if they would be able to get approved again, is the safest thing to just be like, yeah, we're good to go.
100%.
Yeah.
You don't want to go through the documentation again, and maybe you have done a high debt utilization, which was not at that time.
And then say if they tried to play around with it and it was shown that they had issues, are there risks for their current mortgage?
Not for renewing the same
because it's
lender.
not regulated the same way. They don't want to kick people out of their houses on renewals.
Right. But you still want to keep your finances in place, right?
Of course. Yeah.
Yeah.
It goes without saying.
Yeah.
Well, maybe it doesn't. I don't know.
Yeah. So like that other things, like, I always, when client comes, I try to understand their needs, what they actually need.
Yeah.
Right. And you want to give the solutions what they actually need. Because, if the client is in an older home, having that extra $15,000, $20,000 line of credit, which is just sitting there, you only pay when you use it.
Yeah.
And they have to do renovation. Guess what? You don't have to
go get approval. You don't have to
go for all the hassle. Well, guess what? I have that $15,000, $20,000 I'm taking out. Mm-hmm. I'm fixing this thing up and I'll make my payments. Mm-hmm. Easy.
Yeah.
Right?
Perfect. Yeah.
Yeah.
Okay. Anything else in terms of like beyond interest rates thing to look at? Because that's like, I'm kind of the same way as my clients in a lot of ways, that I'm like, oh, what interest rate did you get? Oh, great. But it's like, there are these, did we cover off the main ones?
Yes,
there?
I think we covered off it. Yeah.
So residential, we covered a certain amount of that. And I'm sure there's more we could go into that, but you also do commercial mortgages.
Yes.
And so they can be quite different. So how do commercial mortgage approvals work compared to residential ones? Are there key differences in the criteria the lenders use? Like, is that the income of the property itself? So say if it's an apartment building, what it is, like what qualifications do the buyers need for commercial loans? What type of loans exist for these types of businesses? If you can kind of dive into that.
For commercials, there is like couple of programs that goes around. One is like MLS Select, which is like a CMHC insured program for multi-unit residential.
Okay.
Right. And they can take up to amortize it over 40 years. Mm-hmm. And you can have a good loan to value of that buildings too, like around 90% also.
Wow. So you can do 40-year amortization on apartment buildings?
Around 40 years, up to 40 years amortization.
And that is for any kind of apartment building?
Yeah, but it has to meet certain criteria that are there. Like,
what are the down payment requirements for that?
Like,
typically,
if it goes loan to value up to 90%, right? Or you come up with 10%.
Right. So, I mean, when you're dealing with apartment buildings, you could be dealing with $4 or $5 million transactions easy.
Yeah.
And so, so that 10%, that's $400,000 to come up with. But then, what about the criteria for the buyer themselves? Say if they could come up with that, them and some partners have access to the $400K. Yeah.
They can come up as a partners, and there's special requirement.
What about that? Yeah, what are their requirements?
Like, they should be good standing.
So,
right, as whatever the persons who are coming to invest, right? That they should have net worth.
Net worth,
right?
Okay, yeah.
And the credit score should be good, and that the balance of the down payment is coming out from there, or like the investor.
Yep.
However they are coming up with it,
but it's not the same debt service ratio requirements. Or
no, it's they do they have the debt service.
But it's based on the income of the property itself.
Too, right? And then there's the appraisal that goes in, right? That is the property worth that, and then they have requirements of the energy efficiency and then the rent. So this all kicks in there to do it under certain programs, right? And then there is like, just a standard commercial lending that people do come and take it, which something like for a commercial, which is multi-unit, like a commercial space and rental units on it, like you need around 25% down payment, but you also need a solid
So
business.
say if it was like retail or like, doctor's offices, or like, I guess that would probably be some special program.
Yes, for doctor offices, there is lenders, they would do up to 100%
Whoa.
if they have a doctor office for commercial.
Whoa.
Yeah.
Whoa.
Yes. So
100% means you
up
don't
to
have to come up
100%.
with any money as the buyer.
Yes, there are special programs for
and
commercial.
then you yourself, what kind of net worth requirements would you have for that? So say if you just had like net worth, like you had a principal residence that was worth $400,000 and your mortgage was $200,000 on it. So you got $200,000 there. Do you need like, and maybe you got, $100,000 in equities and stock or something like.
Yeah, that should be good enough.
Really?
Yes.
And you could buy like a multi-unit medical center.
Yeah, you can open it, and
does it all have to be the medical center?
Not
the whole
all,
thing?
but the doctor has to operate his office.
So the doctor operates his office.
And 50% of the building should be occupied by him.
Oh, okay. Okay.
Yeah.
So if there's multiple doctors, that would also count.
Yeah, that will also count. Yeah.
Okay. Interesting. Whoa.
Yeah. So like, like telling you currently.
Can you build using that?
For MLI Select one, you can build a residential building, and not for the construction side, for the doctor office. But if doctors are occupying something, nowadays lenders
lease agreements.
Yeah, doctors are
with the doctors.
Yeah, because like the doctor, if they have like, for example, a commercial unit is there, and right now somebody's doing a retail, and there is a rental unit on the top, but the doctor is buying it. He should be like, he should be proving enough that, okay, that retail space is going to come out on closing, and I will be going in and starting my practice. And this is what things going to go. Because, if a lender is doing that much for you, they have right to audit, right?
Yeah, so they have to check that that's what actually happened. So say what happens, the person intends on moving in there, they get the loan, then they say, you know what, I actually would prefer to set up my office here and just keep renting this out to the current person. They could get audited, it could be trouble.
Yes, like they could, right? And like, I don't want to quote them that you...
Obviously, you're not going to suggest that, but I just mean like some kind of, I don't know. Yeah. There's some kind of crazy moving cost from their current lease. They have a cancellation fee on their lease there that is preventative of the, I don't know.
So then they should figure out before they go in.
Right.
Yeah, and
What about when you're doing commercial, what kind of accounting do they expect from the apartment building or say if it's a
anything
medical office or retail or whatever it is?
If you're coming up like the documents wise, like, you need a solid business plan.
Yep. Okay.
Then you need the projections of you, how the business gonna perform under you if you're taking an existing business.
It's business plan.
Projections.
So that would be kind of like, you could have kind of the income, the expenses. You could have, say, if you're putting into your lease like a CPI, percentage increase in rent, or annual, 4, 3, 4, 5% or whatever it is that you have it. You put that into the projections, and you have that. It matches with what your lease is, and then you look at what kind of airtime electric's going to charge you, all these different things, your utility costs. You see that, like, how profitable does it need to be?
Enough to cover your payments, right?
But much more than that.
You should have, because like any lender,
well, you want it, obviously.
You want it, like they will lend it only the mortgage, it only like you are able to afford the mortgage payments, and you're going to make money out of it, right? If the business is running dry and lost, no lender wants to put that money in,
of course. But if it is profitable,
then
but what if it's only like a 5% profit margin?
Then they
might just look at it and be like, that's a little tight. Like, how good are you with these numbers? Because that's a lot of risk to take on, versus it's like a 50% profit margin is kind of like, well,
right. But then, even though there will be some more, I'm not saying most of the time, but they could be sometimes comfortable with it, because, what if that person has history of working in retail for 10, 15 years, right?
Right. So they really look at the applicant.
They really look like,
experience.
Like how the background is matching it.
Bankers are more like, these are specialists.
Yeah. Like they really want to see, like, are you specialized on running a retail?
As a mortgage broker, are you working with these different underwriters, and are there local underwriters that you work with for this kind of thing? Because that's a big scale, right? Or how does that work? Are you underwriting it? Like, what's going on?
Like we do underwrite things in our commercial one, because we bundle up the whole package, and then only we can send it, right?
Yeah. So for the uninitiated, an underwriter, usually you have kind of the mortgage broker, or you have the lender that you're working with at the bank, and usually whoever is actually providing the loan has their own team that goes through the financials and goes through all those criteria that we talked about. And they may ask for specific evidence or proof and things like that, just to make sure everything is verifiable. And then those underwriters kind of just confirm everything is the way it should be. Yeah. Right. But so to go back to this, who's underwriting these commercial loans?
So we generally you can say that, at our office, myself, we make notes and we send it to this lender, and their underwriting team gonna go through it and be like, okay, yes, whatever they are saying about the deal and the documents are provided, is it matching, right? Because you tell stories, but you also want evidence, right? Yeah. So the document, and then they go through it and they will write it their underwriting for the lender, that the lender is comfortable to lend you.
Right.
And like there is always underwriters that are locals too, right? Like in Atlantic, and some of the commercial,
especially for bigger things, would they like fly someone in sometimes to like meet with people and that kind of thing, or not so much?
Not so much. You are just on contact with them over the phone.
So they're signing like bank statements, lease agreements. By the way, there's a little noise in the background. I'm not sure if you can hear or not. Somebody's doing some renovations downstairs or something. I don't know what it is. It sounds like a saw. Right. So just if you hear any sounds, that's what it is. Okay, so the applicant, what their criteria is, what they do, like who they are, it does matter. And then when you're doing the business case and when you're doing projections, you want that all just like click together, right? You want it to be all just like, this is real. Like if you're looking at what the cost of the electricity is, it should be the right kilowatt hour, for what Maritime Electric charges,
Right. Because, the deal just not basically depends on the projection, right? Because they will also see, okay, if, for example, you are operating a retail business, I came in to buy it, right? And your net of like tax return says, well, my business is, for example, doing $50,000 profit a year. And then I come in, okay, hey, I'm going to buy this retail and I'm going to turn into $1 million profit. No, that's not how it works, right? Because you have to be realistic about it.
What we think we could add value, and these are maybe lease agreements to prove that this is this way, and we're gonna set up this new concession stand that's gonna be rented out for $500 a month, and
so you can do the tweaks and
coin
make
laundry is going in.
Right, 100%.
$60 a month, but multiplied, as
there are more washing machines and everything. The laundry saved times by 60, right?
Yeah. It's interesting. Oh man. Okay. So there's a lot more. That's just such a deep and wide topic, because we could get into writing business plans. We could do financial projections. You know what? I used to, years ago, I had this idea of getting into apartment building investing. I never really did. I used to do like small scale, like, investing in properties and stuff, but not like major. And but I used to, there's this guy, Michael Blanc, had this apartment building investing podcast. And for a while, I was just obsessed with it. You ever hear that one?
No, I haven't.
No, I have. I'll have to share with you. Yeah. I paid for one of his premium spreadsheets that gives all the different projections and all the different inputs, and then you can tweak it and be like, "Ooh, the rent's going to go up this amount per year, and this expense, I'm going to get rid of this expense. I'm going to change the heating system, and it'll all kind of self-populate." It's pretty satisfying to look at. I'll share it with you if you want.
100%.
Yeah. What before we wrap up, I am a little curious about how you got into this. Like, what's your background?
So I came to country at the age of 17, migrated from India.
Where in India?
In Gujarat, western part of India.
Oh, cool. It's such a big place. I know so little about it. It's like, is it Bangalore? Delhi?
So, and then went to Toronto, took a biotech. That's my background. Have a diploma in biotech from Ontario.
Oh, interesting.
Moved to PEI.
To work in biotech?
Yeah, and I worked for BioVectra.
Oh, for BioVectra. Okay,
yeah, I worked for BioVectra for 3 years and switched to another company for 3, and again went back BioVectra. But
So that drew you down here, the biotech. Interesting.
Yeah. And I think that's an emerging field on the island. But how I got in mortgage broker was I had my family background in real estate in India.
Okay.
And they encouraged me. And then I was in one of my workplace. I was sitting and getting a thought of what my family recommended me. And I had a friend sitting next to me. And I was like, I think I want to become a mortgage broker. And she said, go for it. Why not? She's like, well, I can see the personality you have. And I'm like, bang on. I researched it and then reached out to my broker, Kim Redden, and she took me on board more than 2 years back with the family of Centum. And I love it. Man. The people are awesome. And I just love the vibe with them. And what an awesome team. Wow. Recently, we won the Chambers and award, like a business small excellence award by Chamber of Commerce. So pretty grateful for all the people and my team. That's how I came into mortgage broker industry. Man. Yeah.
That's awesome. That's awesome. And is there I'm curious what, if there's anything else you want to talk about that we haven't covered in this conversation?
See, as a mortgage broker, or out for the brokers who are out there, this is just what I think is the clients are coming up with us and making their biggest life financial decisions, right? Mm-hmm. And the most important thing is care. Mm. And why I love to be a broker is I like helping people. I have a caring nature, and that's what sets apart of being a good mortgage broker. Because yes, the commission money, you're going to make it. Should be a secondary thing, not a primary thing. Mm-hmm. And that's how I look at my clients. I put the care, and that's the most important. And I love to help people. And that gives me more satisfying than having a bigger fat paycheck from my bonus or commission. Mm-hmm. It's just, that's what I love it. That's what I love for this industry is I'm helping people for making their biggest financial life decision, and I can be a part of a journey and be with them and share. Because after I have closed the deals, I have went to their housewarming parties, I have met the client, and the stories they have shared with me and the smiles, that gives me satisfaction. Love it. And that's what I want to keep doing it, and that's why I'm in this industry. So out there for the brokers, I think care for the clients and meeting their needs and making sure that they are in the best product. That should be the most important.
Yeah, it's so true, man. I have a very similar connection to it in that it's you're helping people get through this just huge decision in their life, and with your particular role, it's you can be okay, let's just tweak these things here a little bit, and then it's oh wait, all of a sudden I can afford to buy a house that I will, I will maybe grow with my partner in, or maybe I'll have children and grow a family, and it's whoa, dude, that's a pretty interesting moment to intersect with someone's life. Holy smokes. Yeah. Awesome. If for the listeners who want to reach out to you, what's the best way of them getting in touch?
They can give me a call or text at my number 902-978-1731. Follow me on social media on Instagram, Jay Patel Mortgage Guy, or go to Centum website and look for me, Jay Patel. And I'm active on social media. Look it up, and I'm always happy to help people, and that's what I'm here for. And love the industry, love helping people. That's my basic mantra.
Awesome. Good job, Jay. That was great. Right. Thank you so much.
Nice meeting you.
Yeah, you too.